Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from a company called Cartesian Growth Corporation 2. Don't worry, it's not as complicated as it sounds. Let's see if their growth is as Cartesian, meaning perfectly straight and predictable as they hope, or if there's a twisted. Before we jump in, if you're into getting the real story from these reports, be sure to subscribe. We also have a Discord community in the description, so be sure to check it out. So what's this report about? Well, it's a Form 10Q, basically a quarterly checkup for publicly traded companies. Cartesian Growth Corporation 2 needed to tell the Securities and Exchange Commission, or SEC, and all of us how things were going for the first 3 months of 2025. Cartesian Growth Corporation 2 is what's called a blank check company, or a SPAC. This means they don't actually do anything yet. They exist to find another company to merge with, bringing that company public. Here's something interesting. As of mid-May of 2025, they had about 21.6 million of one kind of share and only 2 of another kind. That's a big difference in the share structure. To understand where we are going, we will talk about their financials, where we can check out their balance sheet, their income statement, and statement of cash flows. Alright, let's crack open the balance sheet. This is a snapshot of what the company owns assets and what it owes liabilities. Looking at the assets, the most striking number is sawing cash and marketable securities held in trust account. This trust account is the heart of a SPAC. It holds the money they raised from investors waiting for a deal, compared to December of the previous year when they had about 84.5 million in that account. It increased, though this increase is mostly due to earner writing, which is something to take note of. On the liability side, deferred underwriting fee. This is a fee they owe to the banks that help them go public, but they don't have to pay it until they actually complete a merger. Let's move on to the income statement. This shows how much money the company made or lost over the 3 months. Remember, these SPACs aren't usually selling anything, eating operating and formation costs. This would refer to things such as legal and admin costs at net income, which actually represents the profit the company made during that period. It's a positive sign and higher than the cost they incurred. Where did this income come from? Tiffinate interest earned, representing passive gains on holding money in their trust. Theta income, which may represent positive gains such as change in value of warrants. Now let's check the cash flow statement. This tracks the actual movement of cash in and out of the company. The amount of cash in a company is very low, but they can keep spending in the future depending on the interest earned on their trust. It says there's investment of cash into trust account with the same amount being described as proceeds from promissory note related party and convertible promissory note. Now let's move on to the note section of the filing. We'll skip the company details and jump to what is important. The key thing to note here is this: they are trying to find a target. If they don't, the investors will get their money back and the initial owners get nothing. So the clock is ticking. I note that their original date to find a business combination was in 2023. However, they extended that by paying their sponsor. They also have to pay the sponsor for each additional month they need to extend their time to find a target business to merge with. This is a key incentive for management to close any deal regardless of quality. So even if they find a terrible business to buy, they will profit by completing the deal. And speaking of time, second charter amendment to add up to another 12 months. The clock keeps ticking and they continue to get more time. As you can tell, they are really incentivized to make a deal, even though it's likely investors are less thrilled about it now. Here's a big red flag. There is substantial doubt about the company's ability to continue as a going concern. Tolev, since the clock is running out and the company has not been able to find a target to acquire, it is likely the company will just liquidate and distribute the remaining assets to shareholders. Let's talk about earnings per share. The filing states that diluted net income per ordinary share is same as basic net income per ordinary share, and it goes to redeemable shareholders as well. Let's talk a little bit about the warrant liabilities. This is a liability that occurs due to the specific nature of the warrants that the company issued, so be sure to read the filing for more details on that if you wish. Okay, let's look at events that happened after March. It looks like the company's board approved the 5th 1-month extension and drew funds. Also, it was notified from the Nasdaq for failing to do business and will be subject to removal. Now for the wrap-up. So Cartesian Growth Corporation 2 is in a tough spot. To do is what I noticed, the time pressure. They're running out of time to find a business combination and they're paying for each extension trust account reliance. Almost all their assets are tied up in the trust account, which is good for shareholders, but limits their flexibility. Delisting, losing their Nasdaq listing, is a blow to their credibility and liquidity. Is this a good investment based on these numbers? I would be extremely cautious. The incentives are heavily skewed toward management closing a deal, any deal, regardless of its quality. And with time running out, they might be even more desperate. Alright, that's a breakdown of Cartesian Growth Corporation 2's latest filing. What do you think about these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.